Hello everyone, welcome to Lineup Stocks. I'm Will. Recent US market swings have been wild, crashing one day and surging the next. This back and forth is essentially a drama shaped by tariff tensions, the AI hype, and Nvidia's financial results. Trump's tariffs happened just a few days ago. The US Supreme Court ruled that Trump's sweeping global tariffs were illegal. People thought companies would finally save money, but the excitement didn't last long. Trump quickly used different laws to bring the tariffs right back, and he is not just bringing them back, he is making them even higher. Trump recently announced that he is raising the universal tariff rate from 10% to 15%. This is a huge deal. A jump to 15% means the cost of bringing goods into the US will go up a lot. For everyday people, this could mean paying higher prices for things like clothes, electronics, and even food. The tariff rollercoaster is definitely not over. The AI star company, Anthropic, just held an event to calm the market down. Just a month ago, their new legal AI tool caused pure panic, wiping out $1 trillion in software stock value in just 7 days. People were terrified that AI was going to destroy every software job. But this new event fixed the mood. Their product chief made it very clear, "We are not here to steal your jobs or take over your systems. We are just providing the smart tools. You bring your own industry knowledge, your clients, and your trust." This simple message was huge, and it finally stopped the market panic. The market reacted instantly. Stocks that were previously crushed as AI victims bounced right back. The message is clear. If a software company has deep data, strong client relationships, and specialized knowledge, AI won't kill them. Instead, they can team up with AI to make their moat even stronger and more valuable. The most famous AI victim was IBM. Why? Because the new AI could automatically scan and update old computer code written in COBOL. COBOL is an ancient coding language from 1959, but it still runs 90% of US ATMs. Because humans who know COBOL are extremely rare, updating these old systems was a massive, highly profitable monopoly for IBM. But suddenly, AI tools claimed they could do in a few days what took human experts months. This completely shattered IBM's 60-year-old business model, making their expensive human services look slow and outdated. Fresh off the press, Nvidia just crushed its Q4 earnings. They reported $68.1 billion in revenue, easily beating expectations. But the real story is their Q1 outlook, projecting up to $79.6 billion, completely blowing past Wall Street's estimates. The AI boom is definitely still alive. While all these massive macro storylines are colliding, the US stock market is doing something truly unsettling and historically weird. It is basically acting bipolar. We are seeing a bizarre split in the market structure. Let's take a look at today's market heat map. It is definitely a tale of two markets today. The biggest story is the massive rebound in technology. Look at that sea of green. The tech sector is leading the pack, up nearly 2% today. Money is aggressively flowing back into growth. We are also seeing strong gains in financials and communication services, pushing the broader market higher. But it's not green everywhere. Investors are rotating their money out of sectors that went up too fast recently. Energy, including major oil and gas names, is taking a break and pulling back today. We are also seeing drops in consumer staples. Defensive, everyday brands, like Coca-Cola, are trading in the red as investors chase higher growth in tech. So, the takeaway is simple. Money is flowing back into tech while taking profits from energy and safe consumer stocks. We are seeing a massive split in the market right now, and the main reason the index hasn't crashed? The Magnificent Seven. These tech giants are so massive that they are basically holding up the entire market all by themselves. Let's break down the technical chart for QQQ today. At first glance, it looks great, but let's look a little closer. We see a massive gap up today, forming a big, beautiful, bullish candle. However, there are three major warning signs you need to watch. First, look at the top of this candle. It is getting rejected right at this key moving average line. This MA is acting as heavy overhead resistance. Second, check the volume down here. For such a big price jump, the trading volume is surprisingly low. We need high volume to confirm a real breakout, and right now, the volume just isn't strong enough. Finally, look at the MACD at the bottom. True, we are seeing a bullish crossover, but notice how it's happening below the zero line, an underwater cross. This usually indicates a weak bounce in a downtrend, not a sign of true strength. Right now, everyone is playing it way too safe, and defensive positioning is extremely crowded. If the market stabilizes even a little bit, it could trigger a massive short squeeze and force people to chase the rally. But let's be real. Unless the whole AI hype actually delivers real quarterly earnings, any bounce we see is just a bear market trap. Personally, I think this tech bounce is just people closing out their protective puts. Bottom line, it's fine to hold what you have, but do not buy more. Instead, use these rallies to trim your positions and protect yourself from future risks. Alright, this is Lineup Stocks. See you next time.